Imagine you're 10 years old, sitting at the kitchen table building a house of cards. You've got 4 stories going. It's beautiful. Your hands are steady. Then your little brother runs by, bumps the table, and the whole thing collapses in about half a second. Now imagine that house of cards was the entire global financial system. The table was the housing market. And your little brother? That was reality showing up uninvited. That's the 2008 financial crisis.
In the early 2000s, the American housing market was the most stable-looking table you'd ever seen. House prices had been going up for decades. People believed housing prices could only go up. Banks saw this and thought lending money was basically risk-free, so they started lending to everyone. You had no income, no job, no assets? They created a loan category for you, ninja loans. These were subprime mortgages, the bottom cards of the house. Between 2004 and 2006, subprime mortgages exploded from 8% to over 20% of all mortgages.
Banks took thousands of individual mortgages, good ones, bad ones, terrible ones, and bundled them together into mortgage-backed securities. Think of it like selling pre-built walls. A wall might have some strong cards and some weak cards, but from the outside, it just looks solid. Rating agencies looked at them and said AAA, the same rating as US government bonds. Wall Street sold over $2 trillion worth of these between 2003 and 2007. Everyone trusted the rating. Nobody looked at the individual cards. Wall Street took the worst pieces of those mortgage-backed securities and repackaged them into CDOs, collateralized debt obligations. They took the weakest cards from 10 different half-collapsed houses and called it a load-bearing wall. Then they created CDOs of CDOs, houses of cards built on houses of cards built on houses of cards. By 2007, the CDO market was worth over $600 billion, almost all of it built on subprime mortgages. Some people noticed the house of cards looked unstable. Instead of warning everyone, they figured out how to profit from the collapse. Credit default swaps, insurance on someone else's house of cards. AIG sold $440 billion worth. They never set aside reserves. Meanwhile, hedge fund managers like Michael Burry had looked at the individual cards. They'd seen the ninja loans. They knew the table was about to shake.
In 2006, housing prices stopped going up. Adjustable rate mortgages adjusted. Monthly payments doubled. By 2007, over 1.3 million homes were in foreclosure. When the bottom cards fell, the walls fell. When the walls fell, the houses fell. Bear Stearns collapsed. Then Lehman Brothers, a 158-year-old bank with $639 billion in assets, filed for bankruptcy. The next day, AIG was about to go under. The whole house of cards was collapsing in real time.
The government passed TARP, $700 billion injected into the banking system. The Federal Reserve dropped interest rates to 0. The damage was staggering. 8.7 million Americans lost their jobs. The stock market dropped 57%. $9.8 trillion in household wealth evaporated. Congress passed Dodd-Frank. But here's the uncomfortable truth. The biggest banks are bigger now than in 2008. The kid who kept adding cards didn't learn the lesson. He just found a different table.
The 2008 crisis wasn't one failure. It was a chain. Bad loans, blind ratings, insane leverage, fake insurance, and a collective delusion that the table would never shake. The next crisis won't look like 2008. It never does. But it will have the same structure. Too much confidence, too much leverage, and a table everyone assumes is stable. Until it isn't.